Good morning. It's Monday, the 7th of October, and this is Govindraj Ethiraj, headquartered in broadcasting as well as streaming from Mumbai, India's financial capital. The take. For decades, the standing joke was that you could buy a made-in-India watch by HMT, once Hindustan Machine Tools, at a cheaper price in Dubai. What made the joke sadder in a way was the fact that these watches were effectively made and still are by the government of India, as HMT belongs to the government. Now, how does that make sense, you might ask? Well, that, of course, is the beauty of India's taxation structure since time immemorial, where local taxes have been so high that once exported minus tax to countries like Dubai, where local taxes were low, it becomes cheaper. Now, HMT watches are very much around, by the way, in case you want to check them out on their website and even buy them. What is also around is India's totally inverse duty structure, where goods made here become cheaper overseas. The latest example is iPhone 16s. The government and Apple have announced with much pride, and justifiably so, that iPhone 16 and iPhone 16 Pros are being made in India now for obviously export. What they've not mentioned is that the duty structure is such that it's still cheaper to import those very iPhones, or rather smuggle them. So the phone, assuming it's the same set of units, are going around the world and coming back and being sold in the grey market at a cheaper price. Why else would they be smuggled? In the last week, Indian customs officials said they seized 12 newly launched iPhone 16 Pro Max devices from 4 passengers allegedly attempting to smuggle them into India. The passengers came on an Indigo flight from Dubai, the customs department helpfully informed us. In the same week, another 26 iPhone 16 Pro Max phones were seized from a woman passenger, and the phones were in her vanity bag, and she came from Hong Kong. And over the weekend, Apple announced that it will roll out its first ever made-in-India iPhone 16 Pro and Pro Max series of devices this month. So maybe the enterprising smugglers could have waited for a few more weeks for these high-end phones to be actually made and available in India. But then, time and tide wait for no Apple fans. Even if the phones were made in India, the price would be higher. Media reports have computed the price difference between an iPhone bought in Dubai or Hong Kong at the top end versus one bought officially in India at about 30,000 rupees. So a smuggler could, I reckon, make about 10,000 rupees per phone and still offer it at a 20,000 rupee discount as opposed to buying it from an Apple store in India. In India, many people would jump for a value proposition like that. The larger question is, why is this happening even today? Well, let's come back to the HMT example. India's duty structure is still convoluted and high and protectionist, and in many ways no different from the glory days of pre-liberalization. Because among other things, our tariffs and duties have actually been going up after going down. 10 years ago, average tariffs were 13%. Today, they are 18%, amongst the highest in the world and double of countries like China and Vietnam. Companies like Foxconn, who make Apple products in India, have obviously protested the high duties on components that they have to import and managed to bring them down from 20 to 15% because it was becoming more uncompetitive. This has actually been happening with gold too. Our tariff setting has been governed by the moral of taxing gold imports versus the practicality of understanding how flows work in a high tariff environment and what we can and cannot do. So we hiked customs duties on gold in the last decade only to see smuggling rise and then finally dropped them again this June in an apparent recognition that high duties don't help. But that lesson was learned earlier as well in previous years. So if we truly want to become a globally competitive manufacturer and thus create more jobs, we have to reduce tariffs for final products and components. Else, people will continue to buy products that are made in India but in Dubai and Hong Kong, or after the same product is smuggled back from these very countries. And that brings us to the top stories and themes of the day. The markets see their worst week in over 2 years. Brace for more problems. Oil is now inching back to $80 a barrel as Middle East tensions stretch further. How Indian banks are borrowing from institutional lenders to stay in the game. Forex reserves hit a record high, crossed $700 billion. Both Services and Manufacturing Purchasing Manager Index, or PMI, indices are at lows. Port strikes in the United States end, and this could be a fresh relief for Indian exporters.
This is the Core Report with Govindraj Ethiraj.
Brace for more turbulence. So if you haven't already braced for the turbulence, you should be, because the next few days will be tricky. Now, there are a host of factors that are weighing on Indian stocks, which the domestic flows are not able to counter. From Middle East tensions to selling by foreign portfolio investors, the external signals are weak and are likely to remain so. The China shift may start easing as markets reopen there after a holiday, and more on that shortly, but the Middle East tensions are not going away too soon. Oil is already inching back towards $80 a barrel, and last week was bad. Stocks fell for the fifth session on Friday, recording their worst week in over 2 years, and the BSE Sensex fell about 808 points to 81,688, while the Nifty 50 fell 235 points to settle at 25,014. Both indices lost about 4.5% each for the week, and that was the worst since June 2022, with most of the decline thanks to that 2% slump on Thursday, according to Reuters computations. Reliance Industries, which is the second heaviest stock in the Nifty 50, has fallen more than 9%, and that has led losses on the index this week. Bajaj Finance fell about 3%, was amongst the top 5 losers on the Nifty 50. Stockbroker Jeffries said Bajaj Finance's pre-earnings update showed a moderation in assets under management with a 12% sequential drop in new loan bookings, and more on that space on loans and advances coming up later. China stocks are already up 25%. So the question now is, will Chinese stocks start moderating after the record run in the last few weeks? Remember, it's not just about stock prices going up. It's also about the capital that is being pulled out or being reallocated from countries like India and invested in China. China's stimulus packages have already taken the CSI 300 blue chip index to over 25% in a 9-day streak. CNBC reported on Monday, and the index popped over 8% to its best day in 16 years last week, even as the Shanghai Composite Index was up about 8% before the markets closed for a week-long holiday. Hong Kong stocks then dropped on Thursday, ending a 6-day winning streak and sparking fears that the China stimulus could start to fizzle out. But analysts also told CNBC that Chinese stocks will keep rising after markets in the mainland reopen following that golden week break. So China, as we've been discussing here, has moved on several fronts, apart from making borrowing cheaper, as well as a string of other steps to boost the economy, including the real estate business. Now, there is still skepticism on the follow-through. Analysts told CNBC that the key focus will be on the effectiveness of further stimulus measures, and if the policy follow-through is strong, we could see further gains. Other analysts told CNBC that we were still in a period where Chinese authorities respond to weakening data and the thing starts to improve a little bit, and we don't see the actual follow-through. Oil prices are rising. Oil prices have now crossed $78 a barrel, up more than 8% last week, and this obviously now pushes further the prospect, if there ever was one, of prices of petrol and diesel being reduced in India, which, like I said, looked feasible just a few weeks ago. In the latest move, Saudi Arabia has raised its main oil prices for buyers in Asia. State producer Saudi Aramco increased the official selling price of its main Arab Light crude by about 90 cents to a premium of $2.2 a barrel against the regional benchmark for buyers in Asia, according to Bloomberg. At the same time, Aramco has cut the price of oil grades to the US and Europe. So oil has been rising this month after Iran launched missile strikes on Israel in retaliation for its attacks on Lebanon. Benchmark Brent crude, like I said earlier, has gained more than 8% this week. But the macro drivers for oil markets are still centered around demand and how weak it is, particularly in China and the United States. Also, the fact that Middle East tensions on the supply side would not really affect oil production. But that could change if Iran's oil infrastructure is attacked, as some people are speculating, and also if Iran retaliates by choking the supply routes through the Straits of Hormuz. Indian reserves are at a record. While portfolio investors have been selling, dollars are still flowing into India. India's foreign exchange reserves have crossed $700 billion for the first time on record after climbing for 7 straight weeks on valuation gains and the Reserve Bank of India's dollar purchases, according to Reuters. So Forex reserves are now at about $704 billion, having risen by about $12.5 billion in the week till September 27th, and that was the biggest weekly increase since July 2023. Now, interestingly, India is the 4th economy in the world to cross $700 billion in reserves after China, Japan, and Switzerland, according to Reuters, which added that foreign inflows have hit about $30 billion this year, led mostly by investments in local debt after India was included in an important JP Morgan debt index. Forex reserves have gone up by about $88 billion in 2024, already more than the $62 billion in the whole of 2023. Reuters said the valuation gains were due to a decline in US Treasury yields, a weaker dollar, and a rise in gold prices. The rupee has now strengthened past 83 rupees 50 paise to the dollar, and coming back to gold, they're still soft, largely because of stronger than expected US jobs report, which in turn reduced expectations of an aggressive rate cut from the Federal Reserve next month, a move which has boosted the dollar. Reuters reported that spot gold was down slightly at about $2,649 per ounce over the weekend, after having touched a record high of $2,685 last week. Growth in India's dominant services sector was strong but slackened to a 10-month low in September as demand slowed, according to a HSBC final India Services Purchasing Managers Index compiled by S&P Global, which fell to about 57.7% in September after hitting a 5-month high of 60.9 in August. A manufacturing purchasing managers index was also down to a 8-month low of 56.5 in August, which along with a slip in services activity meant the overall composite PMI, that services plus manufacturing, was at its weakest since November last year. Banks are borrowing aggressively. What does that mean? Banks can only lend to you if someone deposits money with them or to start with. Now, deposits have been slowing down, as has been discussed or much discussed in recent months, pushing banks to step up deposit mobilization, including by setting up more branches or marketing efforts. But all that takes time, and the demand is here and now. A report from Reuters, for example, says Indian banks are set to issue more certificates of deposit to meet year-end loan demand as deposit mobilization remains challenging. Certificates of deposit are debt instruments with maturities of less than 1 year that are issued by banks, and the demand for these is likely to be higher this festive season, as would be the case. So the stock of outstanding CDs or commercial deposits have risen to almost 515,000 crore rupees or 5.15 trillion rupees or $61 billion at the end of August. Since then, banks have issued another trillion rupees or 100,000 crore rupees. So consumer loans have grown in double digits in the last 2 years, and that's obviously pushed the overall loan growth. But not so deposits, which grew about 13.3% year on year in the fortnight to September 6th. Now, deposits as a whole have only risen about 11%. Among others, mutual funds are the big lenders in this space. So I reached out to Bhushan, Kedar, Director Funds and Fixed Income Research at Crisil Market Intelligence and Analytics, and I began by asking him to explain the phenomenon of this bank borrowing and also to assess the impact for us.
Just to give you a quick overview of the trends that we're seeing in the certificate deposit market, really is the borrowing typically by banks through CDs was flattish till, you could say, 2020, 2021. However, when the credit started picking up in 22, the demand started going up significantly for CDs. Just to give you some perspective, on a quarterly basis, banks used to typically borrow between about 20,000 crore to 35,000 crore through this route. Now they have grown 5 to 7 times and touched about 1.5 lakh crore. And now we are seeing on a quarterly basis about 3 lakh, 2.5, 3 lakh crore of borrowing. So that's really one key trend that we are seeing on CDs. And obviously that has also pushed yields, saw the trading volume picking up on the CD market. So that's really a quick take on trends, high-level trends that I could see.
Got it. What is the key driver in the sense that why are banks borrowing at such high levels? And because you said 300,000 crores compared to 20 to 30, that means it's almost 10 times now per quarter.
Yes, I was mentioning 3 lakh crore compared to 30,000 crore maybe 5 years back, sort of started picking up. So clearly, credit pickup or advances growth that we are seeing in banks' demand for it is one factor. Two, obviously, the financial savings. And if you look at the Reserve Bank data from the gross savings, the allocation of household is going more towards assets such as mutual funds or, for the matter, even life insurance policies, etc. And for bank deposits, the amount has dipped over the last few years. And that, I think, is one factor that has created a gap in that sense between the deposit and credit rate. And that's really one factor where, to meet the ongoing demand for credit, the CD market is something which is a preferred one. And just to add, CDs is one piece, but you would see banks through bond route have also been borrowing significantly from 2022 onward. So that is the other piece that just would be important for the audience. Yeah.
That's interesting. And what are the figures like there, Bhushan, when you say bonds versus, let's say, CDs or all, if you were to look at the entire basket of borrowings, how is it broken up now?
So banks, if you look at the borrowing around 2019, 2020, was ranging between about 40 to 60, 70,000 crore. From 22, that number has actually touched 2 lakh crore. So it has doubled in 22. It remains similar. And maybe when we close this year as well, we would be close to 2 lakh crore. Certainly the number has doubled over the last 3 years.
My question is more on the gap between bonds, or rather the quantum of the bond market versus the quantum of the certificate of deposit market.
Okay, just to look at the overall data perspective, when I was quoting the bond market, obviously it's a yearly number, which is 2 lakh crore. But CD data is obviously, they are of short-term maturities. And if you will look at the overall borrowing last year through CDs was about 8 lakh crore. So in that sense, it's significantly higher. But yes, they have short-term maturities, and it's basically a rollover that banks tend to do.
And what's the average maturity of a certificate of deposit?
The large maturity bucket would be between 3 to 6, 7 months. That's where most of the CD maturities will typically fall.
And who are the lenders in this market mostly, at least at this point of time?
So investors, mostly on the buy side. So mutual funds are the largest. Their proportion to this would be anything between 60 to 70%, followed by insurance companies and maybe few corporate. And lastly, interestingly, banks also invest in CDs of other banks. And one of the requirements for which they do is typically more for the LCR perspective. This is an eligible instrument. I think that is probably another reason that we hear that does happen.
What is the kind of rates of interest, Bhushan? So, for example, what rate is a bank typically borrowing and what rate is it lending, and how is that adding up?
So in terms of maybe, of course, lending rate, I may not have the data sort of handy with
Very
me.
roughly. Yeah. No, this is like a very rough sense.
Mhm. Sure. So typically, MCLR becomes a reference rate for them, and that on top of that, they typically would be lending, which I think would be north of 780 or 8%, around north of that. If you look at the CD rates that are prevalent today, so that would range from 3-month CD would be about 7.25, and the 1 year will be about 760. So that's really band in which they are operating when it comes to borrowing profile. So if when you look at a broad level, there is about 50, 60 basis spread that I see between this to MCLR. And yeah, the borrowing will then obviously on top of that, and the lending will be on top of that.
So it's a fairly tight market. I mean, between the borrowing and the lending.
So especially for this pace that we see, the yields from July onwards, the spreads over treasury bills have sort of risen by about 40 to 50 basis points. And in fact, interestingly, they are very close to the commercial paper level. So NBFC CPs and bank series, the spread is about 20-25 basis today, which generally used to be north of 50 basis points. So that is the other trend.
And what does that signify?
So that really means that the supply of series is suddenly inching these spreads, and the risk premium between the two is minimal because maybe a NBFC supply is not that high, and basically the supply demand factors are warranting a minimal spread or less spread between the two assets. I think that's really one key takeaway.
So what's the outcome of this all? I mean, what happens when, let's say, we see such high levels of activity in the institutional borrowing by banks, or what we call certificates of deposit instruments?
So I think fundamentally, I think this also is an alarm for, banks the way they are. I'm sure they're seeing it because it's a short term of borrowing and they're rolling it over. And obviously, from a credit perspective, they are lending at the higher side. So from an ALM perspective, banks are also looking at this. So maybe some of the decision they might be looking at is how do they sort of expand credit? How do they grow on that part? Certainly is one piece to really look at. And obviously, from a cost of borrowing perspective as well, it is significantly higher. So I think both from margin and ALM, I think those are two things I'm sure banks are really looking at, this activity right now.
Got it. Bhushan, thank you so much for joining me.
Yeah, thanks, Govindraj.
The US port strike is off. Some logistics news. US East Coast and Gulf Coast ports reopened on Friday after dock workers and port operators reached a wage deal to settle the industry's biggest work stoppage in nearly half a century. But Reuters reported that clearing the cargo backlog will take time. But it also pointed out that the strike has ended sooner than investors had expected, weakening shipping stocks as freight rates were no longer expected to surge. From an India perspective, this is surely welcome news, particularly for Indian exporters who are already grappling with longer shipping times and stress points thanks to ships having to go via the tip of Africa as opposed to going through the Suez Canal. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at The Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.